Hello and welcome to another tax update, brought to you by Tax Essentials for Advisors. I'm your host, Andy Rainford. It's been another quiet few weeks on the news front. That's not unusual for this time of year though, and I've still got some interesting tidbits for you. This week we're looking at a warning about the forthcoming mansion tax, the latest making tax digital development, and revisiting the meaning of life for a limited company. The Chartered Institute of Taxation has raised concerns about the government's proposed high-value council tax surcharge, sometimes referred to as the mansion tax. The new charge is due to apply from 2028 to residential properties in England worth at least £2 million, with annual charges ranging from £2,500 to £7,500. One of the main concerns is that this effectively creates a second property valuation system alongside council tax. Council tax will continue to use property values from 1991, whereas the new surcharge will depend on current market values. This means two taxes applying to the same property but calculated using entirely different valuation bases. There are also likely to be practical issues around properties close to the £2 million threshold, where relatively small differences in valuation could determine whether the surcharge applies at all. There is also concern about potential fiscal drag if the threshold is not regularly reviewed, as house price inflation could gradually bring more properties within the charge. Local authorities will be responsible for administering the surcharge despite the revenue being paid to central government. The Institute therefore argues that the consultation period should be used to minimise the additional complexity and administrative burden before implementation in 2028. We are aware that HMRC is now moving to automatically bring taxpayers into making tax digital for income tax, where it believes they should have been within the regime from April 2026, but have not yet signed up. The process will begin in September and will take place in batches. There is a good reason for taxpayers and agents to act first. When they complete the sign-up themselves, they have a better opportunity to check that the correct businesses and business details are recorded. Once an officer initiates the process, fewer details can be amended online, and some changes will require direct contact. A particular point for advisors is that HMRC will not notify the agent when it signs up a client. The taxpayer will then need to ensure compatible software is in place and catch up with any quarterly updates already missed. No penalty points will be awarded for late quarterly updates during 2026 to 27, but the reporting obligations still apply. The department has recently launched what it calls the Borderline Accepted Estates Project. It is writing to agents who have submitted probate or confirmation applications for accepted estates, where the value was around one of the relevant nil rate band thresholds. HMRC stresses that these letters are intended to be educational, rather than the start of a compliance investigation. The concern is that some agents may be applying the available inheritance tax allowances incorrectly when deciding whether an estate qualifies as accepted. A particularly important point is that the residence nil rate band, including any brought forward transferable amount, is not taken into account for this purpose. HMRC also notes that the downsizing allowance and transferable allowances do not apply automatically and may need to be claimed through an IHT 400 form. The practical message is therefore to be careful with estates that sit close to the relevant thresholds. HMRC says valuations and any allowance claims should be properly supported when deciding whether a form is required. Where there is genuine uncertainty, filing the form may be safer than treating the estate as accepted and discovering later that tax, interest or penalties are due. This case concerned a fairly narrow but important point about who can be liable for inheritance tax arising within a trust. Lex Green had established the trust in 2005 and the trustees were resident in Jersey. A 10-year periodic charge later arose and remained unpaid, so HMRC pursued Lex Green as the settler. Lex Green argued that the statutory wording only imposed liability where the transfer occurred during the life of the settler. Its case was that a company does not have a life in the sense contemplated by the legislation, so the provision could only apply to an individual. The upper tribunal rejected that argument. The definition of settler refers to any person, which can include a company, and the word life is capable of referring to the duration of a company's existence. The tribunal also looked at the purpose of the legislation. The settler's liability is essentially a secondary recovery mechanism where the tax has not been paid by the trustees, and those trustees are outside the UK. Excluding corporate settlers would undermine that purpose. Interestingly, legislation introduced in Finance Act 2025 now expressly confirms that references to a corporate settler being alive or dying mean the company being in existence or ceasing to exist. The tribunal viewed that amendment as clarifying the existing law rather than changing it. This case looks at when an overdrawn director's loan account is treated as written off. Mr. Quillen was the sole director and shareholder of BOH Investments. When the company went into creditors' voluntary liquidation, his loan account was overdrawn by just under £440,000. Following negotiations with the liquidator, he paid around £57,500, leaving a balance of £382,456. The liquidator's final account, issued in March 2019, said that no further funds were expected in relation to the loan. The first-tier tribunal had accepted the taxpayer's argument that the balance had not actually been written off, placing weight on the fact that the liquidator subsequently described the position as unresolved and said there had been no formal write-off. The upper tribunal took a different view. It said that a write-off is a matter of substance rather than form. There is no prescribed formal procedure which must be followed, and importantly, a debt can be written off, even though it technically remains capable of being recovered later. Here, the liquidator had reached the point where he regarded the remaining balance as having no realistic recoverable value, and recorded that position in his final account. That was sufficient to amount to a write-off. The timing was also important. The tribunal found that the write-off occurred on the 18th of March 2019 when the final account was issued, rather than when the company was later dissolved. The Section 415 income tax charge therefore fell into 2018 to 19. The tribunal did flag a potentially difficult consequence. A taxpayer can suffer the income tax charge on a written-off loan, even though the debt may theoretically be recovered later, with no obvious relief if that happens. That's it for this update. I'll see you for another in a couple of weeks' time.
Thanks, Andy. Just a quick reminder that we will be hosting another free CPD accredited webinar next week on the 26th of August. This time the topic is tax-free benefits and the opportunities and traps surrounding these. And our special guest is Jack Bonehill, Chartered Tax Advisor with PKF and host of the Tax Professionals podcast. Use the link below to register. Hope to see you on the day.